Hello all, thanks for joining. Just as we're going into this, we're just waiting for a few more folk to join. It's a beautiful weekend had by all. It's a shame to see the rain back in Brisbane again, but hopefully we're starting to get to the end of that. So it's been a delightful time of late to spend outdoors and going around. Over the weekend, it was my daughter Sarah's 19th birthday, and able to go and see the new Top Gun movie. So I went and saw the Top Gun Maverick. Fun fact, the second movie I saw, because growing up as a kid, we actually didn't have a TV until I was around 9, living in Maryborough by that point. And one of the fascinating parts of that was that when we did get a TV, all we had was then ABC and SBS. So the movies that I saw as a kid were first Monty Python's Meaning of Life, and then secondly, after that, I saw Top Gun Series 1. So to see the second movie ever and see the sequel over the weekend was actually a lot of fun. So it was a great movie, strongly recommend to go through. And then we went down to Canungra for a bit of a weekend away down at doing some high ropes climbing with all the kids. So again, 9 of us heading down for a big sort of weekend out there. So certainly a lot of fun indeed. So I'll just give it one more minute to go through. In terms of just as we're sort of waiting just for a couple more people to join in, one of the interesting sides over the weekend, just speaking through what I'm looking at today, is you might have noticed that, so there was the Chinese flew pretty close to one of our surveillance aircraft in the South China Sea, so in international waters, and the Chinese J-16 fighter then threw off a bunch of flares really close to the Australian surveillance plane, putting the Australian team at risk for chafe going into the engine and similar. So that's kind of an interesting step up in Chinese aggression, which was perhaps not as expected. And the other thing that I've spoken to a few of our clients about over time, including on Friday at the client seminar, was that I subscribed to an independent news service for my Ukraine-Russian war news. Now, this particular news update, I get one of these sent each day. So it's an independent journalist group located globally, and we fund it through donations and similar. So each day you'll get this, 29-page sit rep of, what's happened around Sovereign-esque. Ukrainian forces have taken back control. It's then linked and referenced to, how many missiles were exploded, and all of the facts is fairly well fact-checked. So when you go through, it's all referenced, and it goes through and sort of it has assessments to go into it. A lot of maps that go into it in terms of the way of what's happening today in the war. And what they use, interestingly, for this is they use something called NASA FIRMS data. So NASA FIRMS is NASA's actually space mapping of looking for fire information management. So what that allows them to do is actually see where fires are occurring, and they're using that to determine artillery fire or similar. And that's allowing them to sort of get a first-hand news of, this is where the conflict line is. So you've got this sort of Sovereign-esque and sort of where the Ukrainian control lines are. For those who are interested, send me an email. I get one of these every day. I'm happy to share this. It contains a lot of fairly fascinating intel that's perhaps not shared in mainstream news. So with that, I've got a couple of minutes, so I'll flick now into the main presentation. But if you'd like to get a copy of that, then please let me know, and I'll do my best to send it out to go into that. So recapping, I guess, some of the interesting sides from Friday and just going through. And today, the mission, and one of our great clients, Frank, actually gave some excellent feedback, is to explain perhaps that, we should containerize, this is our seminar about what's going on. And then perhaps the feedback that Frank gave was actually quite excellent, where he said, perhaps right off this, the questions of, does anybody have any questions about infrastructure as an asset class? Pause, capitalize that, and then move into, I guess, a more broad general discussion. And using this as, I guess, a group way of being able to ask questions today. Please make sure it's interactive. If you've got specific things, you'll see the question and answer thing down the bottom. And happy to sort of work through and say, look, let's not just talk about, I guess, infrastructure as an asset class, which is not really the focus for today. It's talking about, I guess, what's occurring globally and around the world. In local news, and I mean in Brisbane side of it, there has been obviously a massive green swing. So this particular slide sort of goes to this fact that at the moment, perhaps it's an outcome that there's been so much floods in the last period and climate change or whatever else is occurring, but there is a massive number of now greens parts within Brisbane, and that's been quite interesting to work through. Politically, this will be challenging, not perhaps in the way that the House of Reps works, because obviously Labor has majority control of the House of Reps, but they don't have control of the Senate. So we imagine that anything that the Labor would like to get passed will require Green support. And if it doesn't contain the right concession, that there will be probably a fair bit of backroom dealing to make sure that Labor gets support to pass through their bills. From an investment landscape point of view, what it probably will do is result in a slowdown of the typical rate of change where quite socialist agendas in terms of changing minimum wage rates, which is obviously in line with what the Greens would expect. Those things will be passed through. The approval of new power stations or other sort of bits and pieces may get quite sort of complicated depending on what that process is from there. As we're all wrapping into the end of financial year, there's a couple of key changes that the Liberal government changed just prior to being removed. And a lot of those are quite good for our style of clients, which is the ability to sell your home and contribute above your $1.6 million cap, also known as the downsizer contribution. So you can now do that at 60 instead of waiting until 65. To access that, you need to have owned the home for 10 years and to have lived in it at some stage during that process. And if you can do that, you can then contribute an additional $300,000 each, so husband and wife, onto your super. And that includes if you're over the $1.7 million cap. So it's, I guess, a good strategy from there. There's previously restrictions that you could not contribute to super if you didn't do a work test. That's gone now as well, up until age 75. And now you can do a bring forward where you can add up to $300,000 to super, regardless of the value at that time. And there's, for our clients' kids, there's a lot better first home super saver scheme for the home buyers. And that's before any of the changes that Labor's proposing in terms of equity contributions, where you can contribute both into the same house. So the first home super saver scheme allows young people, and we're seeing some of our clients contributing on behalf of their kids to their superannuation accounts and to claim a deduction for that. What happens is, let's say that you were to contribute $15,000 into your adult child's account, and they're assumably on, say, the 35% tax rate. That $15,000 will be taxed at 15%, the way that typically you'd expect a superannuation contribution to be taxed at. And then they can then withdraw those funds to add that towards a house deposit. So effectively think of it that the arbitrage between their marginal rate at 35% and the super rate at 15% means that if they put $15,000 in, it's a 20% differential in tax rates. And that 20% allows them to fast forward their savings. The interest is then taxed within the superannuation environment as well. So it's a lot better way of considering what's occurring from there. In terms of, I guess, our principal role, and it's a good understanding that we're not here to time the markets. We're not here to buy gold, sell silver. It's about sort of making sure that from a capital markets expertise, yep, we understand capital markets. But when we think about what our role is, to think about is asset allocation. So do we have enough overseas? Are we diversified? Do we have everything sort of set out to reduce risks? What do we do with income during the year? Do we outsource investment management to experts? Yes, we do. do we think about our clients' goals? What means what's important to you is very different to somebody who might be young and starting off. And it's something you think about estate planning, you think about those family complexities of wealth equality and how do you balance out multi-generational wealth across the groups. And then looking about protection strategies of, if you were to be ill, how do all those things work? And talking about family meetings and family education. And of late, we've been, I guess, as the clients have been aging, and some of the clients I've seen them for 20 years since their retirement. We've suddenly had to be a lot more involved with their kids as their kids have had to sort of understand, their parents' aging processes, and we're there to support them from that. So our role sits in that family wealth advisor space. It's the most intimate role that there is. It's not the buy gold, sell silver type. So we're proud of what we do with that. Going in, I guess, into what on a weekly basis is still causing, even Friday night last week, the market had 3 weeks of good sort of positiveness. And then here we are on Friday night, decided to say, no, inflation's still a problem, how we fix it. Ultimately, that's come from the impact of expansionary monetary policy settings. How expansionary, if we sort of think about this in a different way, and we go US national debt, and we find a little graph. I'll just change the screen sharing from here to here. That new share and change this one. There we go. The US national debt of the United States is that it has gone up a lot. So federal debt as a percentage of GDP, this keeps it in relative terms as opposed to dollar terms. And that's probably more important to think of it. The extra amount of money that was injected into the economy was phenomenal. So that's the total public debt. When you think about that in dollar terms, it's now sort of sitting at that figure of around $25 trillion. And a lot of that's been in that last since the post-COVID period. Interestingly, equity markets have jumped up by as much as this. If we then consider the balance sheet of the Fed as well, there is sort of a concern that a lot of where asset prices have been pumped up is cheap debt. And how do we actually manage to, I guess, allocate capital throughout that? What's, I guess, occurring in real terms, though, is that central banks are behind the 8 ball. What this Bloomberg sort of graph down here indicates is that GDP in 2022 is lower than inflation. So that means that in real terms, the economy is not growing because inflation's outpacing GDP. If we go forward to 2023 and 2023 inflation figures, the expectation is that inflation will moderate next year. And that's the European Commission forecast. But as we can see, the expectations and outcomes can be quite different. So we end up sort of a period of what's notionally called, I guess, low growth and high inflation. Some people use the word stagflation. We don't think that the world's heading towards a Zimbabwean sort of issue of hyperinflation. It's stubborn higher inflation. Hyperinflation is something where it's something that's limited mostly to countries without the ability to export, to control the way that money works. So within, I guess, the modern economies don't have the same risk of a sort of area. For those with grandkids and kids, Minions is still a favorite icon. This is my idea of what the central bank is trying to do. They're trying to race forward to raise rates, and they're trying to stop inflation as it stands. In doing that, it's often that they can overshoot because they're trying to keep inflation down from circa 10% in the US at the moment. And this is the equivalent of in the 1980s when perhaps some of our older clients would say, well, you don't know what it's like to have a 15% mortgage. And you go, well, this is somewhere where the jump, just because of the size of mortgages now are reasonable to have, a $1 or $2 million mortgage is apparently an okay number. What that's occurred is a change in bond markets that have been the worst since 1840. And that means that anything that you previously defined as a safe investment like government bonds, etc., you've encountered one of the first negative returns year on year for many years. And if we consider, I guess, what that looks like for investing, I'm going to use, in this case, QSuper in Queensland. That's probably one of the largest super funds going around. And if you decided last year to, go from aggressive to diversified bonds and go, as an investor, I want a short to medium term fund with steady returns, it's going to be their lowest risk option. However, you should be prepared for the value of investments to have small movements over time. So if you did that last year, as of the end of May, a week ago, you would have lost still 7% in a diversified bonds strategy. So the safest option you could choose in QSuper lost 8% last year to the end of May. So this is a very complicated time to invest. If we then go to, I guess, to growth equity markets, so we go to FANGM, which is Facebook, Apple, Netflix, Google, Microsoft. Now, it's now MANGM because Facebook's now called Meta, but that's slightly less funny. Well, it sounds weirder. Now we look at that as an index. So over the last 6 months, that's dropped 30%. If we just go the entire composite index of the tech index, that's down 18% in the last 6 months. But if we take the benefit of time and we go back 5 years, the last 5 years has resulted in a 98.4% increase in the value of the average sort of tech-based index. Yes, the last, since November through to today, has been down, but we are seeing what begins to look like the bottom of this area. So it is a challenge to sort of work out how did it feel to sort of have this massive rise and that feeling of exaltation that we now get back down through. But if we go back over a long time frame, and this graph goes back to 91, and I start with $10,000 and I just go, look, I'm just going to buy every share in the US and buy the index. I'm going to buy every share in the Australian market, and I'll just keep reweighting that back to the averages across that whole time. The $10,000 grows throughout the Hawke, Keating, Howard, Rudd, Gillard, Rudd, Abbott, Turnbull, Morrison governments, throughout Trump, throughout Biden. 10 grand still turns into 217. We've seen downside before. In fact, the safest times to invest have been after the down bits. So this time of investing isn't the time to go out and run away. What's driving this volatility and inflation, in our view, remains the Ukrainian war mixed with China. Zelensky's saying Russia controls a fifth of the Ukrainian territory. But that territory is now a lot of abandoned villages. There's stories of 100,000 person towns down to, say, 10,000 people left through. So is it a victory to control a fifth of the territory if nobody who lives there still remains? In terms of, and this graph is accurate to the 31st of May, obviously it changes a fair bit over time, but what we discussed previously in our Ukraine-Russia update was that the Crimea contains a whole bunch of liquid natural gas assets around the Black Sea. So within the Crimean Peninsula, around this area, is enough energy to run Europe for many years. So when you consider that when Russia annexed Crimea in 2014, a lot of that was to prevent Ukraine from being an energy competitor at all. So a lot of the pipelines that Russia run from Russia into Germany, those pipelines have connectors in Ukraine. So the idea that the Ukrainians could just build gas plants, and BP and Shell were doing so, and then reconnecting and just disconnecting the Russian gas lines, obviously was a challenge to Russian economic control. Now, the issue previously, though, was when this part was in Ukrainian control, Crimea didn't have a land bridge. So it was a peninsula with its border, but Russia had no ability to actually get supplies or drive any degree of control through here. So the destruction and deletion of Mariupol as a town really has given Russia the ability to, in theory, get a highway of trucks or whatever else down to this area through here. There's a little town here called Severodonetsk in the middle of this area, which is what they're fighting over at the moment. It's a challenge because the the military systems that the West has given the US, the West has given Ukraine have been insane. One of the biggest sort of systems that you'd think was a relic back to the World War IIs was the M777 howitzer. So this is an old school piece of rocketry. This is not looking like some weird missile system that goes through. It's rounds that go into it. What happened though in the late 90s and early 2000s though was a company called Raytheon Missile Systems. They built a guided fin-based version called the Excalibur round. Now, the Excalibur round, this is quite relevant to why the US's military support has absolutely M92 Excalibur. Same thing, but these fins deploy when the missile is sent into space, so sent out of the artillery system. But in the front of the system is a radar-controlled system, and these fins are directional. So they can accurately, over about 40-odd kilometers, land within about a meter or two of the enemy. These rounds are enormously helping the Ukrainians to delete large parts of Russian resistance with very guided, low Ukrainian losses. So they're nowhere near the front line, and they're using drones to get GPS coordinates to go through. A lot of the testing ground of what's been given to Ukraine is stuff that the US has probably never wanted to really give away, but now they're allowing the Ukrainians to fight a proxy war to go into it. How's Russia responding? They're cutting off gas. They're saying we want to be paid in rubles, we want to be paid not in US dollars, and any country that doesn't pay us in the currency we want, we're going to turn off the gas supplies. Now that means the rest of the world's struggling to find the gas that they need to do it. And we'll go on to, I guess, the energy and security issues of that. But this is gas that's used to run gas-powered power turbines. This is gas used in central heating throughout these sort of European very cold countries. This is gas used in industrial production. So this is not an optional, well, you could just cook in your microwave sort of area. What's causing from there is the flow-on effects of energy and food inflation. And these things are being priced into shortages of grain and fertilizer, causing mass hunger and famine, as the World Bank says, I'm going to try and do what I can. But the world needs food. That's how the world works. That's not really an optional area. So I then sort of go into, I guess, how's China's response to this? China's then saying we want COVID zero, and they're causing an economic slowdown. And the idea that shops are boarded up, that people are forbidden from operating their businesses, and given the world supply chain still starts typically in China, there's supply shortages and there's issues that are going to result in something called nearshoring, where companies have to start to go to higher cost production in their own countries, which sounds lovely, but it does mean higher prices globally. And the fact that the Chinese have labor units that can still compete and create that value. So where does COVID zero work, and will China continue running with it? It's creating a lot of uncertainty, and that uncertainty is being reflected within share markets. So therefore we have the only place that's safe left to be in the moment in the terms of we're a long way from the war in Russia, we're a long way from China, we're a long way down here, is Australia just chunking along. We're talking, decreasing unemployment, GDP that's just GDP per person that's just going, yep, we are completely flying along. We're growing year on year on year. We've done that partly just because of the high amount of debt that we've pumped in, but also because we export coal, iron ore, wheat, uranium, gas, oil, copper, gold. We are sort of like a mini Russia in the way that we still can actually supply the world that it needs during these supply crises. That said, if the world goes through economic hardship, then Australia's obviously has to find through there. But at the moment, there's no other supply solutions other than Australia. So we're confident that Australia probably is still a safe place to live in and a safe place to be a citizen of. And it gives us a lot of, I guess, surety that we're still the lucky country. The challenge of that, though, is that the gas we sell overseas, and over the weekend, they pulled the gas supply trigger, which means that gas companies have got 6 months to guarantee a certain amount of supply to Australia, is causing an enormous change in gas prices. So for reference, gas prices in Australia are dominated by the amount of wholesale electricity supply. So in the national energy market, over the last, say, 2 years odd, it's reasonable that the wholesale power price averages around 60 to 80, and it's been trending up the averages a bit lately in Queensland as an average power price. So what that causes is during some really large peaks, so last Thursday night, it was about 7 p.m, the wholesale power price, which sort of averages around that 40 to 100 sort of value, that hit $708 a megawatt hour. Now, that's resulted in New South Wales demanding, in terms of the consumers, needed 11,400 megawatts to turn on all the heaters and air conditioning units and turn on the TV. But New South Wales Power Generation was only able to generate 10,300. So that involved Queensland exporting 2,688 megawatts. New South Wales still getting short, so they were double drawing, so we normally draw down from them as well. 685 megawatts being exported from Victoria, and little old Tasmania is supplying Victoria 314 megawatts from their hydro systems. So Tasmania has suddenly become this energy power exporter. The challenge of all of that is that these generation assets are drawing down on gas prices that are jumping from $10 a gigajoule to $800 a gigajoule and averaging now at $40. So that's a 4 times price increase in gas in the last sort of couple of months over this Ukraine-Russia area. So from that, we're going to find that power prices jump. In fact, there's been a few power companies go, please customers leave. We genuinely cannot afford to buy any more power at this wholesale prices. We're going to double your power price if you stay with us. And that's just because of the fact that a lot of these power generation assets might be gas turbine, and those gas turbines are having to buy gas at a high price, and for them to turn on, they're demanding a higher power price. When we talk about infrastructure, though, it's about owning the poles and wires, not owning power generation. Power generation still has enormous amounts of variability, inability to control your on and off price. So let's imagine, though, that during this time, we said, you know what, perhaps the safest thing to do is to get out of the market, and it's all too complicated to be invested at the moment. We'll sit on the side, we'll wait for everything to sort through, we'll wait for Russia, Ukraine to declare it's all over, and we'll sort of just get out of it for the time being. The problem behind that is that, just as we saw in COVID, there didn't need to be a vaccine or a cure. We just needed to feel that real risk go away. So if over the last 10 years, you decided to get out and you missed just the 10 best days. So the initial model is you took 100 grand, you stayed in the market, you never sold out, you went through the ups and downs of it. And over those 10 years, just sitting in the market, no active return, you would have turned up getting 460 grand for your 100 grand. Missing just the 10 best days means that your potential return would have dropped from there. So you don't know how quickly this might come over. If there was a peace deal coming out of Russia, Ukraine, we suddenly might end up back in a time where the market just surges back up 10, 20%. If we miss 20 days, if we miss 30 days, or if we miss just 51 days, and that's over 10 years, then the idea of timing in and timing out is that you might do the worst thing, which is sell low, buy high. You might go, okay, everything's better now. The market's gone up 10%, I'll get back in. Then it drops off and you keep wash, rinse from repeating. So timing the market's almost impossible to do in this day and age. You're better off to have active management where their job is to try and value opportunities, and then just to have the patience to know that over the long term, equity markets need to continue to go through. In terms of our team and what's happening at the moment, we've employed a new person, Travis. So Travis is our school teacher reform. So he's come across from 17 years as a school teacher. Previously, he chose special needs as a vocation within that. And then about 2-3 years ago, he started studying financial planning and then said, I'm going to be a financial planner. And he started his professional year now. Marcel has joined us. He's recently moved from Switzerland, as he's had a baby 5 weeks ago, to an Australian girl. I've tried to convince him a number of times already to move back to Lucerne, Switzerland, because that seems very beautiful. But he's committed to being a parent. So his wife apparently doesn't speak German. Jade's come on as a compliance manager for quality assurance. And then Sarah's about to finish her professional year. And in this case, little Oliver, my brother, is he's our practice manager now. So that means that he's trying to make sure I'm on time to meetings and get through. So our teams had to expand in line with, I guess, the increased regulatory needs, what we need to do on a day-to-day basis. Recapping on last year, because this is, I guess, the first client seminar we've done in 2021. Last year, we won Lonsdale's Practice of the Year award. And then we also were listed for the Financial Standard Top 50. The importance of these sort of campaigns is that we get extensively audited through these award processes. And the idea of that being that you've got other people who can compare financial planning firms to work out, are we exercising the best of governance, the best of advice? Are we doing the best we can do? And then ranking us against our peers. So for us, we're not doing it for the accolades of just being the best. We actually enjoy the process of going through the awards process and going through the questionnaires and having people come out to the business and look through our control systems and understand how we regulate and look after almost $1/3 billion of client assets in here. I'll quickly just cap through the Atlas slides and just sort of cover off on, I guess, what's occurring through that. So Atlas is one of the fund managers that we use as part of a diversified portfolio. Infrastructure is sometimes about 10% of a client's assets. I guess in this period of uncertainty, understanding why infrastructure as an asset class gives you some resilience to understanding it. And infrastructure gives you regulated long duration assets. It gives you poles and wires, water networks, railroads, airports. It doesn't go into the idea of owning Swanbank Power Station or anything weird. It's trying to say, I want the electric, gas, water, pipelines, toll roads, mobile phone towers, airports, and the railroads. So it's basically like playing the game of Monopoly. And once you own all of a rail asset, or once you own an entire rail line, it's unlikely that somebody's going to build a new rail line. In the case of, say, owning Eurotunnel, being the tunnel across from Calais in France through to the UK, nobody's going to build a new Eurotunnel. Nobody's going to take a new Japanese Shinkansen railway line and build it once next to it. And a lot of the way these contracts are written is take or pay. So the government's actually awarding an infrastructure asset owner. I think in Queensland, nobody's going to build a new Energex to be in competition with the old Energex. A lot of these slides, and I'm going to be fairly quick with these slides as they were in the presentation as well, is that the long-term returns of infrastructure are fairly straight. And the reason for that is that the assets have a regulated asset return rate. And what that simply means is that the government affords the asset owner a particularly flat rate of return. So if you own a power network and it's worth $100 billion, the government says you can earn 8% on that power network as your profit margin. So over the long term, if you take 8% and you start compounding it, you end up with some fairly high numbers. As the presenter did on Friday, I'm just going to skip through a few of these. The reason that we like Atlas is that now if we go through, yes, during periods of sell-offs, this is COVID, they sold off just as anybody else would sell off during that period, but they dropped down less. So the mission is that no asset should be a straight line. Things should roughly be mark to market and things should fall away for a little bit. What we liked and what we've seen recently, though, is that even though the world share market reflected in grey has declined, what we've seen is infrastructure, because it is a strong inflation hedge, has actually surged up to go through. And Atlas as an infrastructure asset manager has actually done better than the average of other ones. And this is the importance of active management. So in this case, what you can see is that active management's outperform passive, and infrastructure as an asset class does as well as equities, and even of late has given a slightly better return because those equities have sold off since November. Infrastructure, because it's an inflation hedged asset, has done better. The case study is a lot more interesting than the slides to go into it. And it's about sort of understanding that as we transition towards an electric world, what we need is poles and wires. Poles and wires are irreplaceable, and nobody's going to create a competitive market to run that beside it. When you hear words like IRR, so investment, the internal rate of return of the investment, effectively that's to say, if they calculate what the investment would earn over the next few years, they're saying that it should generate a 17% rate of return for shareholders. And that's excellent compared to, I guess, what we would consider a 7 to 8% long-term rate of return. They're saying, look, we bought this asset in March 2018. We bought it at $4.50. The share price is now $7.77. And they're seeing as regulation continues to try and take Russian gas out of the system, and they're trying to move away from these different types of energy. The electric energy and the use of renewables, the use of storage, is requiring a massive upgrade in the transmission networks to be able to take on, in some cases, very large wind farms that turn on. And those wind farms then need to then massively dump gigawatts of power through the network in surge. So the power networks need to be big enough and strong enough to be able to take this surge power and to redistribute that around the entire of Europe at once. Now, in this case, what's interesting is the idea of active management is that you can take an initial position, then you can add to it. And so as the share price might be volatile, they say, look, it looks cheap. It might drop down, and we go through to stories such as, the Eurotunnel. So if you think about the Eurotunnel, there's something that, obviously during COVID gets a lot of impact from the outcome of nobody traveling from Europe to England. But as we move towards higher energy prices, the idea of suddenly taking a flight from London through to Paris is a lot easier to take the tunnel. There's been some recent legislative changes in terms of France has decided to ban short haul flights. So in April this year, France has said, internally get the train. We do not want you jumping around. This at the cost of energy, the Paris climate solution. So the government's just said, we're going to, we have BBC World News, got less ads on it than Forbes. France moves to ban short-haul domestic flights. So the use of railroads throughout Europe, as those have travelled throughout it, is going to continue to see investment within that infrastructure. And that's partly just because obviously these giant big aircraft, they do require enormous amounts of land. They also require a lot of liquid fuel, whereas these things can run on a lot more renewables or other types of power generation. And they can take a lot more passengers and a lot less sort of safety risk from there. So in terms of understanding why you want to say own a railroad, is that Europe has decided that they'd like to just jump between each other. And again, that is a ton of rates of return around 14, 15%. So volatility is our friend because it actually allows us to enter into different assets. One of the interesting stories that came up on Friday was around Atlantia and the fact that these were the ones who had a bridge collapse, which killed a bunch of people. Now, the volatility around that negative news, so the Genoa bridge collapsed. In this case, Atlas have been watching out for them throughout this period. Suddenly the government gets quite concerned because it turns out that Atlantia was sending all of their earnings to invest in overseas assets and wasn't doing the required maintenance and renovations. There's a massive liability. The government gets quite upset. And then later, suddenly we go, cool, they've resolved and they've fixed up a lot of their positions, and then they get taken private. So in that case, what happened is that they made 34% rate of return just simply by buying something once the corporate governance and due diligence had been taken place. So as we sort of go through, that sort of theme continues. It does come down to a reduction pathway, and regardless of how you feel about climate change, or regardless of how you feel about the transition through electric generation and how we actually look at total emissions pathway, there is a commitment to reducing carbon globally. Its success and whether or not that's effective in changing the path of climate change is for if it's capable of, if we've gone beyond certain event horizons, is beyond my sort of pay grade. But to approach that, we're going to need a lot more in transmission networks. We're going to need a lot of infrastructure to actually be built around it. The great thing about infrastructure as an asset class is that typically doesn't want to hold shares in the actual solution. So we're not investing in the actual the wind farm itself. It'll be the connector that the wind farm has to connect onto, that the wind farm says, I want to pay to build a transmission line up to the point that we get from the farm. So the owning in that side of it gives a lot more stability and certainty for our clients through that period. There's a lot of numbers and slides in these graphs that are amazing for that side of it. One of the interesting facts before we sort of wrap up into questions, if that's okay, is the transition. So Manhattan bans gas. So if you say in what New York City's gas ban means, so they're saying we're phasing out gas in new buildings. So New York Times is probably better than that other one. So New York City said, no, you can't put new gas heating and new gas stoves in your building. In the new buildings, they're saying nope, and there's a massive transition plan around that. And we're also seeing this transition in California. California gas stoves is Los Angeles' ban on gas stoves could spend the end for many Korean barbecue restaurants. So Los Angeles is huge. Like California, the markets that are changing out of this and the need for infrastructure assets to be built around this are a growing side of it. So the world is changing. Our role is to sort of stay abreast of that and make sure that we've got a little bit of money sitting in each of those assets. I've said before, and I often use Peter Costello's, one for mum, one for dad, one for the country. And for a bloke with 6 kids, I had a few more after that. But I use their 50 Michaels that sit in a room and Australia's sovereign wealth fund as a benchmark to where we think we should be investing at, because that's ultimately through there. So if suddenly Costello's got around 8% in infrastructure and timberland, I go, okay, that's probably not a bad number to have. If suddenly Costello's got in private equity 16%, then that's probably not a bad number to have at all. And as part of that, he's a little bit low because Australia's sovereign wealth fund is designed to diversify risk of Australian sort of idiosyncratic risks. So a lot of the risks are in investing only within our own market. What we can see here, though, is that it is actually the process he's gone through. How's he gone over the last few years? He's done well. So diversifying towards infrastructure, private equity, all those sort of asset classes will still be an extra way to go through. The world still has some uncertainties. There is the ability to raise your hand as part of the audience participation members to type in a question. I can then push allow to talk, and you can just free text it if you want to talk, or we can run a Q&A. I can see 2 questions have come through, and I go through to, I guess, Frank's sort of questions, and I'll just glue these together as part of them as they go through. Does the wealth of Australia through its natural resources go to resource companies like BHP? Does it all go to the nation via government revenue, compared to Norway, which makes sure the nation's benefits from its resource wealth? And Australia is a future superpower green energy exporter. So I'll answer this in 2 ways. So answer live. So what we're going to consider with Australia's ability to ship all of our goodness away is Norway did something different. So the Norway Sovereign Wealth Fund, they required the wealth of all their oil assets to go into half of basically the oil assets to go into their Sovereign Wealth Fund. So the fund's market value. So we go and do this NOK to AED. So that's $1.8 billion. Now that compares to Australia's sovereign wealth fund, which is around 200 odd billion. So they've done a lot better because they said we're going to divert the wealth of our oil assets and we're going to effectively nationalize them. When we sell them, we're not just going to give all the wealth to the mining assets to go through. So the Norwegians did better at this. They've also, because of their sovereign wealth fund, they've been able to invest a lot earlier into the energy assets around the world that have diversified away from natural gas, so from oil infrastructure and away from fossil fuels. So they've taken shares in solar farms. They've taken enormous sort of changes through the world to be ahead of a lot of the changes in terms of the future of investments. So that wealth has grown phenomenally for them. A lot of this wealth has then allowed them to set up the people of Norway for many years. The way Australia's done it, though, is we've ended up giving away a lot of our oil assets. So when we sell Australia's sale of national assets, gas, I'm just trying to answer this one live. We probably aren't going to end up using our own gas pipelines. It's going to end up being shipped to the rest of the world because we decided to not actually nationalize our assets. The Gordon gas fields, a lot of the things that we did were basically to give private shareholders the ability to take advantage of that, and that wealth's gone overseas. So when we think about why has Australia done differently, now what we do have is BHP. So BHP is now the world's largest mining company. And when we think about sort of how much money they're making in US dollars, they're making $13 billion worth of net income off $60 billion in revenue. They are the most diversified mining company in the world. So they own every single sort of thing you can sell, from copper through to gold, through to iron ore, uranium. There is nothing that BHP doesn't really do. They own the lowest cost infrastructure assets. They're committed to climate change by trying to diversify away from just liquid gas fuels and trying to go more into reliable side of it. They also have, and perhaps from a sustainability point of view, one of the world's biggest issues is tailing storage facilities. It doesn't sound like something that's overly exciting, but once you run a mine and dig everything out of it, you end up with these massive pits of toxic sludge water that's not good for the environment. And these tailing storage facilities have to be considered to be run for the rest of the world's life, like some of these uranium ones. And we saw what happened in South America when one of the tailings dams went kablamo, the Samarco event, and we go through and say, how do we make sure that we don't screw this up? Because suddenly nations then say, we're going to fine you for the fact that you've destroyed natural ecosystems and environments. So in Australia, we're lucky that we've got BHPs and Rios to diversify and take away from the risk of missing out on the energy transaction. And interestingly, the sustainability approach of focusing on the environment and continuing it, and I guess being ethical, having good governance standards, and working towards those fundamentals, it'll actually result in the sustainability of their corporate earnings, that they don't have a kablamo event that takes out a lot of their wealth. So in terms of a green energy super exporter, our green energy realistically will become, we're so far from the rest of the world. The only thing that we can really help the world with is we sell uranium. And what's happening around the world is there is a bit of a transition back towards perhaps nuclear power. And Bill Gates, in one of his talks about how the fact that perhaps the only Bill Gates nuclear power, TED talk on this, and basically goes, the only thing really left is nuclear power. So nuclear power is a green solution. It's the only thing that probably is sustainable enough to create zero emissions to do this side of it. And it also results in, I guess, energy independence away from Russia, energy independence away from even the way that the Saudis and the other autocratic states sort of result in that side of it. So if BHP owns uranium, so if we own BHP, we sell uranium, they need iron ore for those nuclear power plants and similar from there. So if there's chat, where is Frank? So if there's any other questions or anything else afterwards you would like to send through, and if those that Russian NASA firm side of it, it is, if that's something that is of interest, there is quite a fascinating amount of news that goes through. There's one that I was texting with Tom just the other day on, is just the military tactics that are in play around Sovereign-esque. And, you know, you've got the idea that Russia actually was set into a trap, that they talked about every single part of the Russian command lines, how these things are failing. However, the NATO-provided M777-based one systems are far more accurate, and Ukraine has been firing these areas, hampering this area. It was the trap, and then suddenly the Russians have been absolutely sort of pushed back again. So if you are interested in that side of it, I'm happy to share those through. Just send me a note and I'll send through those emails to go through as well. No worries. Well, I'll close it off there. Again, anytime, any questions, please let me know. And I'd love to catch up and chat in general or anything specific. I'm positive about the share market. I'm positive about what's going to happen for the future. I think, you know, the market's correctly reflecting that there's a lot of stress. But in 5 years' time, you know, the value of equity markets will be higher than what they are today. And none of the changes in equity markets, in our view, will change our clients' retirements or their ability to continue to enjoy their retirement as it stands. Thanks again. Anytime, happy to catch up.